Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hello, everybody. Welcome to the podcast. So today we're going to be talking about the One Big Beautiful Bill Act. I call it OB3 I'm a big Star Wars guy. I'm also a big Star Trek guy, but Star Wars. So I like OB3. Reminds me of Obi-Wan Kenobi. And today, just to date this podcast, we're filming this on July 10th. So OB3 was just passed and signed into law back on July 4th. And when I reviewed the legislation, there's a lot of just kind of continuance of the Tax Cuts and Jobs Act. But then there's these little nuggets throughout of really cool tax items. And so before the law was even signed in, I contacted the guest today, Austin Carlson. I said, hey, we got to get you on. We got to talk about a couple things that I think are right up your alley: qualified opportunity zones, bonus depreciation, qualified small business stock rules. And I want you to give us the 1-2 punch on what's going on there. And so welcome, Austin, back to the podcast. You're now a frequent flyer on the podcast. So welcome back.
Thanks for having me, Mishkin.
All right, awesome. Well, let's just get right into it. So the first topic that I want to talk about with you, and I know that you have a passion for this area, is what's called the Qualified Opportunity Zone. Tell us a little bit about or otherwise known as QOZs. Tell us about the QOZ, because it's something that was brand new, introduced with the Tax Cuts and Jobs Act of 2017. So give us some background about it. Tell us what would have happened if TCJA had expired. Give us all the deets about, what did OB3 bring in that's new, planning opportunities, all that jazz.
Yeah, absolutely. So the Opportunity Zone regime, like a lot of things in the OB3 bill, there's a lot of continuation of things that were created originally in the Tax Cuts and Jobs Act, the TCJA. That was in the first Trump administration. It was passed and effective at the beginning of 2018. And one of these programs was, as you mentioned, the Opportunity Zone program. The Opportunity Zone program is a tax incentive program that's meant to encourage investment into economically distressed census tracts. Throughout history, there's been a number of times where Congress has implemented these types of programs. This is kind of the latest flavor of it. And the idea behind it is that it's provided tax benefits if you met these very specific rules, specifically around investing capital gains that you recognized. So, and those capital gains could be any capital gains. So sale of a business, you could have sale of Amazon stock, any type of capital gains you can think of. If you reinvested them within the time period, which there's hundreds of pages of regs, and I won't bore you with all the rules, but generally 180 days, sometimes can be a little bit longer, you would get originally 3 tax benefits. And those tax benefits were, if you invested at the start when this first came out, you could get either 10 or 15% of a haircut off the original capital gain. So you just don't pay that tax. The program then contemplates that as long as you hold it until at that time there was a set date, which was December 31st, 2026. If you're still holding the investment at that time, you do have to recognize the capital gain that you originally deferred, but you got the haircut if you held it for 5 or 7 years at that point. You got deferral, which originally 8 years of deferral using like a present value discount factor could be, half of your tax is gone because of deferral.
Right.
And then the big tax benefit, the reason why everybody's in the zones is if you then hold it for 10 years or more, any additional gain that you recognize is completely excluded. So that's a massive tax benefit. A quick example, let's say you had $1 million of capital gain, you would have to pay $238,000 tax on it. If you held it at that point for 5 or 7 years, you would get either 10 or 15%. You don't have that tax is gone, so 24,000 or 36,000 deferral for 8 years, and then if that $1 million goes to $2 million or $3 million, you don't pay any tax on that. Now, the issue, for us practitioners is the program in the TCJA had an expiration date. The benefits were declining over time because to get that haircut, you had to hold for 5 or 7 years, and the measuring period ended on December 31st, 2026. So after a few years, we could no longer get the haircut. Okay. And today, the deferral kept getting less and less because, again, there was a fixed date of when you had to recognize that gain. And then further, the program, you had to get any benefits at all, it was effectively going to expire at the end of next year. So what's exciting for those who like opportunity zones is this new legislation makes this permanent, and it kind of fixes the benefits in a way where they're not going to be declining like they were before. So talk about those 3 benefits again, right? The haircut or reduction in the original capital gains. That is no longer going to be tied to a specific, you have to hold it to a specific date. It's just if you hold it for 5 years from whatever date you invest the capital gains, you get a 10% discount, if you will, on your capital gains. The deferral no longer set on a specific date. It's just you get 5 years of deferral, which is a material benefit whenever you invest the capital gains. And then you continue to get, if you hold it for 10 years or more, you get the gain exclusion on the sale of the QOZ asset. So it's the other thing is this program, they've now basically made it that every 10 years where there's going to be a redesignation of tracks, and this is going to be a permanent part of the code until, unless and until Congress changes it. But it's not in the TCJA, it was going to expire. Now we have something that is more evergreen, and the benefits are going to be consistent and not kind of declining over time.
Gotcha. And do I need to go out and find like a qualified opportunities, like a firm that has options for me? Can I create my own qualified opportunity zone? Like how does someone even know where to go for this kind of stuff?
That's a great question, and we get it all the time. So again, any capital gain can be eligible for this. So if you got a material amount, or even if not that material amount, because of your options, you should consider it. So there's kind of a range of ways that you can do it. One way is pretty much every large financial institution has an opportunity zone product. So they have gone out there and they've created, they've qualified for the opportunity zone, and you can just give them money and you will have an opportunity zone investment. Now, that is easy, but the downsides of it is that in general, you're going to be paying the financial institution fees, which makes sense because they put this together. Right. And like with, all kind of illiquid investments, because this is not going to be publicly traded stuff, you've got to be considerate of, when will you be able to get your money out with liquidity, especially if everybody's kind of investing at the same time. Once everybody gets to 10 years, there may be a little bit of a rush to the exit. And so it's very easy to get in and maybe a little harder to get out.
Right, like The Godfather. You think you're out and they pull you back in. Okay.
Exactly. The middle category is there are kind of smaller private sponsors that are doing the same thing that the banks are doing. Okay. There may be lower fees on those. You may have a little more visibility into exit strategies with that. Also, relatively easy, but you got to know where to look for those. It's a lot easier to Google JP Morgan Chase Opportunity Zone Fund versus finding a sponsor who's got a real estate fund in your backyard. Okay. But you can also, you hear the word fund and you think it's a bunch of people, but you can actually make your own fund. It does have to have at least two owners or two separate taxpayers, but those two separate taxpayers could basically be you or you and your spouse or you and a family member, or you and an S corp that you make, because an S corp is a separate taxpayer. So we at the firm, we do a lot of work when people again have liquidity events, they sell their business, they say, hey, I want to do an opportunity zone, and we find, they find a real estate investment that makes sense, and we can structure a fund that is basically just them owning it. And as long as it meets all of the different qualifications, we can give them the benefits. So lots of different ways to do it. You just got to think about, you got to do it yourself. If you can find something, that's great. Not everybody can. You can go with a big institution that has its pros and cons too.
Okay, a couple follow-up questions for you. So I'm a U.S. citizen, but I've got a foreign capital gain. Like I sell a house in a foreign country, or I sell a business in a foreign country, but it's still a capital gain in the U.S. Let's just say it's not a PFIC or something crazy like that. Will that qualify?
Yeah, it's a good question. It's interesting. We give presentations on this a lot, and I've got a fun comparison of 1031 exchanges versus qualified opportunity zones.
Okay.
So qualified opportunity zones are extremely broad in what capital gain is eligible. And to the best of my knowledge, and I don't know anything that's different in this bill, a foreign capital gain would be eligible for, any capital gain is eligible for investment. If you contrast that with 1031 exchanges, which are a type of deferral solely related to real property, right, there are clear regulations that if you have a sale of real property outside the U.S., you can only 1031 into other property outside the U.S. Whereas with an opportunity zone, there's no restriction on going from foreign to U.S., et cetera. So there's definitely an opportunity there for somebody who wants to bring funds to the U.S. But of course, you've got to take a look, and if you're going to owe tax in the foreign jurisdiction, maybe you just pay the tax here. You got to weigh these things in the international context.
Okay, now let's do a reverse scenario. I'm a non-resident alien. I've invested in the U.S. company, and I've got an effectively connected gain that's a capital gain. Can I take advantage of the qualified opportunity zones on that gain?
If you're a non-resident, that's a good question. I mean, I don't see any reason why you couldn't, but I have admittedly not had any non-residents that are looking to do opportunity zone investments.
That's a rare thing to come through.
Yeah.
I honestly think that would qualify. I think, again, if it's effectively connected capital gain and they're taxable on it, I don't see why it wouldn't qualify.
I agree. I mean, you got to think through, you're continuing to, leave things in the U.S., which you may or may not want to do as a non-resident. And of course, we can get into all the fun of being concerned about estate tax as a non-resident too. But we haven't seen as much in the non-resident space, but there's no reason why there couldn't be some planning. Especially if you're a non-resident from, a country with a low or no tax rate, then I think that Middle East, et cetera, if you're not going to pay tax in your local jurisdiction, having something that reduces or eliminates your U.S. tax burden becomes very attractive.
Yeah, I mean, in my head, I automatically think of like New Zealand, right? They don't have a capital gains tax. And that's a common problem with U.S. taxpayers living in New Zealand, or New Zealand non-residents investing in the U.S. They're always surprised at the capital gains tax. Okay, a couple quick follow-up questions, and then we need to shift to bonus depreciation. So talk to me for a second like I'm a 3-year-old. You said that if I hold the QOZ, I get a haircut on the capital gain. I just want to understand this though, so that everyone can kind of make sure that they have a good understanding of this. When you say haircut, are you talking about the tax rate is lowered by a certain percent, or the actual gain amount is lowered by a certain percent?
So the tax rate, when you recognize the gain, and under the current regime, it's going to be 5 years later. Okay. It will be whatever tax rate is applicable to you at the time of the gain recognition.
Okay.
Under current law, top capital gains rate's 20% plus the net investment income tax could be 23.8. The 10% haircut would be, if you have $1 million of gain, you only have to recognize 900,000, and then you would multiply that 900,000 by your whatever the applicable tax rate is. One comment on that is, and we had this concern when the Biden administration was floating increasing capital gains rates. If today's rate is 23.8%, but if 5 years from now a new administration comes in and raises capital gains to 40, you're going to be paying that 40% rate. The other comment is that both short-term and long-term gain is eligible, but for deferral. But 5 years from now, it doesn't turn, even though it's been 5 years, that 5-year deferral period doesn't turn your short-term gain into long-term gain.
There's no magic dust that's sprinkled on the
ground. It's not like a 1031 exchange where you tack your holding period. So, but then again, if you're going to recognize gain, 5 years of deferral on 40% tax rate is huge.
Yeah, I mean, you're probably still up at 20. You're dropping that down by half, probably.
Absolutely.
Okay. All right. Last question. Now, you're in Texas, and so you may have folks that don't have state income tax. But in your experience, do a lot of the states conform to the QOZ rules? Like, would you ever have a weird thing where you're deferring the tax at the federal level, but you're unable to defer it at the state level if you have a state income tax due?
Yeah, I'm pretty sure California doesn't conform to it. I don't know. Okay. There's I can even find it. They're online. There's a map of which states conform and which states don't. No big surprise, right? Like nothing's easy in California. So you certainly have to, take a look and make sure you're getting the benefit, both at the federal level and the state level. And that just kind of is what it is. I would also say there's a lot of states that are in response to OB3 are going to decide what they're going to conform to and what they're not. And so I think this is going to be a developing area as states are, maybe concerned about, losing revenue or looking at their budget deficits. So, this is definitely something that's going to change over time. This law, if you guys are like searching online, you may be like, man, the article I read, that's not consistent with what Austin said. It's like, well, is the article talking about the House version, the Senate version, the reconciliation? Like, you need to look at stuff that's come out since Trump signed the act on July 4th. So, because things change very rapidly over the last 2 weeks.
Yeah, and the other lesson there is always pay attention to what the states are doing. Especially, you made a very astute observation. The states, I kind of saw that as well. I think a lot of the states will do non-conformity, meaning they won't conform to OB3, and then they'll have a different set of rules, which will make planning for this from a state income tax. Every state may have a different take on how they do it, so you have to look closely to make sure you don't miss something there. Let's move on to bonus depreciation, because when we talk about this, we always talk about, you're going to, you get the client that's, high net worth, they're going to buy the jet for their business, and then they're going to, deduct the full amount under bonus depreciation. Talk to me real quick about what happened in TCJA with bonus depreciation. That's Internal Revenue Code Section 179, little b. What happened with OB3, what opportunities there may be, kind of where we're at with that.
Yeah, and if you don't mind, I'm going to just go one last comment on the OZs.
Yeah,
there's a new thing they put in that is like a supercharged rural opportunity zone.
Oh, I love that.
Yeah, so if you're in a town, I think it's like less than 50,000, or not in or next to a town with 50,000, you get a 30% haircut, and you don't have to substantially improve things as much. So very interesting. What I'm thinking in my head is like data centers, warehouses. Those might be good opportunities to take advantage of that big benefit if you can plop it into a small town or an area with not a big population. So interesting. Yeah. You did not have anything like that in the old version.
Yeah, and I think that spurs. I mean, just thinking in my head, you think about places in Georgia, Texas. I know Virginia. When I was there, they have little towns where they have data centers at. So that's probably going to help those rural areas a lot. That's fantastic.
Yeah. Okay, so bonus depreciation, this is a big win for anybody that's got a trader business. Bonus depreciation, typically when you buy a capital asset, it's different than an expense, right? Like if you pay a salary, you take a deduction immediately. Mm-hmm. You buy a capital asset, the rules have generally been you depreciate over time because, if you buy a computer or something, right, you get a benefit for it over multiple years. And so the tax code kind of conforms to that and says, well, we're going to give you a deduction for it as you kind of use the asset. Bonus depreciation kind of differs from general accounting principles and says, notwithstanding the fact that you're going to benefit over multiple years, you're going to get a deduction for it up to 100% right now. And so that's a huge benefit. If you go out there and you buy a bunch of, trucks, or you buy a bunch of machinery for manufacturing, being able to get immediate tax deduction for that means, you're going to pay less taxes this year, which in a way kind of means the government is helping to finance your business and your growth. And if you're always growing, you're maybe paying little to no taxes, until such time as you're not growing. So it's a deferral mechanism, which we talk about a lot in tax. There's exclusion with opportunity zone, which is awesome. That doesn't exist in that many places in the code. There's character differences when you can get capital gains, which is great. But a lot of tax planning is timing. And so bonus depreciation is a big timing thing. So that's a big benefit. The bonus depreciation is another one of those things that has come on and off over the last 100 years. A lot of times during recessions, the IRS or the Congress would turn it on. Most recently, the Tax Cuts and Jobs Act had bonus depreciation starting at 100%, but then it declined over time. So in 2025, we were actually only at 40% bonus depreciation. And next year, without the OB3, we were going to be at 20% bonus depreciation.
Yes.
So this turns back on 100% starting, I think it's next year. I got to double check that.
Okay.
And here, okay, it's placed in service after January 19th, 2025. So it's actually retroactive, but not to the very beginning of the year, which is kind of odd. So if you bought something January 18th, sorry. It's one of those rare pseudo retroactive because you haven't filed a tax return yet. So that's a big benefit. The other thing that is pretty wild is generally bonus depreciation applies to tangible personal property. So think, equipment, fixtures, things like that. But there is a special provision, and it's temporary, that there is certain property that is a non-residential real property used in qualified production activities. So, the Trump administration is talking about wanting to increase U.S. manufacturing. Manufacturing would count for this. If you, newly construct a factory, you can actually 100% bonus depreciate that building, which is also absolutely wild. And I'm not aware of something like that we've had in the code. Typically, it's been, like I said, property that's like 5, 7, 15-year property. Buildings are depreciated over a much longer time. So again, if you were to build a manufacturing plant, being able to get an immediate deduction for everything you put into that building, that is a real exciting benefit. So businesses that are looking to expand, they really need to take a look at that. That is a very unique and new thing.
Okay. And the amount of bonus depreciation, I think under TCJA was up to $1 million. Is that right? Has that changed?
No, there wasn't $1 million limitation on that.
Oh, it wasn't $1 million. Okay.
Mm-hmm.
All right, great. Anything else on bonus depreciation that we want to talk about?
It's also going to be very helpful in the 1031 exchange world. We had a lot of issues because when people did multifamily or office, if they did a cost segregation study, they would identify personal property and then they would get deductions for it. Okay. But then they were getting deductions for it at like the 100% level back in 18, and then they're doing a 1031 exchange now. And when they acquire the new property, the personal property they paid gain on, but then the new stuff they acquired, they were only getting a 40% deduction on. Right. So getting back to 100% there's just a lot of places in the code it's going to be helpful. But if you're looking to expand, this is a huge, huge opportunity to have the government, float you money by you not having to pay taxes for a while.
So just to wrap up here then, if you talk to someone that's a non-US person, but it has does manufacturing or has some kind of business, and they want to come inbound into the United States, are you trying to then focus them on potentially setting up a permanent establishment, boots on the ground, here in the US to do that manufacturing based off of these new rules and maybe some other rules? Is that kind of one of the conversations that you're having?
I think if you're looking to do business in the US or looking to do business in different places, let's say you could manufacture in, Europe, in Mexico or the United States. Obviously, there's pros and cons to each of these and, labor considerations. But this bill very clearly is meant to encourage U.S. manufacturing, encourage expansion of U.S. businesses. And if you came into the U.S., these deductions are going to significantly reduce taxes for a number of years, which would help if you were modeling out the financial situation. I would say, take a look at this. Before this, you're paying 21% tax. Now you're going to pay 0 tax for a number of years, and that's going to help your cash flow and it's going to make it, a more potentially financially profitable enterprise. So I think it's definitely something, anybody looking to do inbound or anybody considering the United States as one of many places they could do business in or put boots on the ground, big tax benefit here.
Okay, perfect. Moving on then to the last topic of this podcast, qualified small business stock. And just briefly before you get in, I mean, basically same questions on the other two, but before you get into it, let me just say, from being the accountant that sees this stuff, a lot of times what happens is that we have to get a memo from an attorney that details why the taxpayer qualifies for it's Internal Revenue Code 1202, why they qualify for the 1202 treatment. There's a lot of checks and balances that kind of have to be thought through and documented. So one of the big questions I have is, obviously give us all the deets related to the qualified small business stock, but, does your firm do those types of memos? Do you think those are still going to be needed moving forward? Those are some additional questions I have, and kind of the value of why you would need that.
Yeah, absolutely. So we regularly deal with 1202. For those of you who don't know, 1202 is it's like a unicorn provision that you could potentially get a 0% tax rate. Not a lot. I mean, although I was talking about the other one earlier, which is the opportunity zones, right. But hard to do much better than 0% tax rate, guys. We do our best. The 1202 stock is certain types of small businesses, if they're held in C Corp form, and there is a very specific list of what businesses qualify. As an example, Mish and I, as accountants and lawyers, absolutely do not qualify as qualified stock. The code does not like us service providers. But if you're out there, making widgets, there's a whole different line of other types of businesses that qualify. You can, if you meet all these requirements, when you sell the stock, pay 0%. So this is one thing that's the depending on where you were in time, because it's gone on and off in the code over and over again, has changed a lot. Under prior law, you had to hold the stock for 5 years. And when you had an original issuance of the shares, the value of the gross asset value of the company had to be 50 million or less. This new law provides kind of a interim gain or kind of a sliding scale of benefits. So if you hold it under prior law, you hold it for 4 years, 364 days, you don't get anything. You got to get the 5-year holding period. But under OB3, if you hold it for 3 years, you get 50% gain exclusion. 4, you get 75. 5, you get 100%. It increases the, what is a small business? Kind of what is the asset value on the date of the issuance of the shares from 50 to 75 million. And then there was a cap on the amount of gain you could exclude. That cap was $10 million. That being said, there was lots of ways that you can kind of increase that, including by making gifts to spouses and trust. So you can, if you have 3 kids, you can make a trust for each kid. You could give shares to each of those trusts, and each of those trusts would get its own gain exclusion. This helps supercharge that a bit because we go from 10 million to 15 million. Okay. Now, what Mishkin was talking about is to qualify for this, it is a hyper factual question, and not one question, more like 20 questions. Yeah. Because there's all this technical stuff you got to meet. Like, are you one of those? Are you good business or bad business? Are you, Mishkin or Austin? You're in trouble. Are you a business that the code has said is going to get this benefit? Great. You got to make sure there's original issuance. You got to track the shares. You got to track the holding period. You got there's all kinds of stuff you got to look at. So when there's a material amount of gain from a QSBS situation, typically accountants will work with lawyers like us. We draft these opinions all the time where we kind of review, do the checklist and say, yep, you qualify. Sometimes they don't. We've had issues where we looked into it and they didn't have the 5 years, or we couldn't prove the original issuance. But if you can get it, 0% tax rate, get that unicorn.
And would you tell, a client if they're just starting out that maybe this, and if they feel like it's going to really take off and be a big business and that they would potentially qualify, would you tell them to work with you at the beginning, even if they don't have a lot of cash to pay the legal fees? Is there value to that? Or do you think you can kind of come in after the fact later on down the road and cure any issues that may be there? Or, what's your take on that?
Yeah, I mean, choice of entity is critical, and it's not something that you can go back in time on for some of these things. And we could do a 2-hour presentation on should you be a C Corp or should you be a pass-through. And it's a lot of tough considerations. It depends on your business, depends on your exit strategy. So I think that the 1202 is great. I more push people when they're tech companies that aren't going to have a lot of interim income and they're looking for an exit, especially that is likely to be an IPO or an acquisition by a publicly traded company. That's a really nice fit for a C Corp. On the other hand of the spectrum, friends don't let friends put, U.S. persons put real estate in C Corps. Foreign persons do. It's a different story. So It really depends on your industry, and there's a lot of, different rationale. But yeah, it is critical that you get good tax advice when you start a new business. Even if it costs a little money, it can save you. I mean, the clients that didn't get that QSBS, if they had called me at the front end, I could have saved them, $30 million tax for a few hours of consultation.
Let's say I'm a U.S. person and I own a shoe factory in foreign country X, and it's a controlled foreign corporation. I own it 100%. Could I create a U.S. C Corp and then tuck in as a subsidiary that controlled foreign corporation and then qualify for these rules when I sell the CFC stock? Is that something you see or have feel like that might work in this situation, or that's something that would probably not work?
Are you selling foreign stock? Because I don't think foreign stock qualifies for this.
Yeah, well, let's just say you sell the C Corp stock. You never really sell the CFC stock. The CFC stock just kind of comes along with buying into the C Corp.
Okay, I'd have to understand your fact pattern of like what's where.
Yeah, I can see a lot of people asking that though. Like, hey, I've got this foreign company, but it's owned by my C Corp, and I'm going to sell my stock in my C Corp, but I'm not going to sell my CFC. Mm-hmm. And it's just the CFC ownership's going to kind of float along with whoever buys my C Corp stock. So
if the CFC is a subsidiary, yeah, I don't think that causes an issue at all. Other than you do, okay, I will say you've got to look at. There's also like qualifying asset tests and things. Mm-hmm. And you would have to look at whether the subsidiary like causes issues with qualifying. And, again, it's very factually intense. So is it possible to have foreign operations in a foreign subsidiary? Yeah, but I think you really have to look at and make sure, you're meeting all of the, like I said, myriad of, unfortunately, boxes you got to check to get the 0% right.
Does your firm do that? Do you do that as a service where you will write those legal opinions? Have you done tax insurance before?
Yeah, so tax insurance is fascinating, and we're seeing it a lot more. We see it especially with M&A transactions where the buyer and seller know there's a legal risk. For example, state tax exposure is big. International, we did one recently where we were concerned about recharacterization and there being withholding tax. And so, within the M&A context, a buyer, may say, look, you've got $30 million of tax exposure. I'm going to make you put that in escrow until the statute of limitation runs. Ooh. And if you're the seller, you're like, I want my $30 million. Yeah. And so tax insurance covers that gap and says, all right, we're going to pay an insurer, and it ranges, but it can be 2 to 5 cents on the dollar, and they will insure that risk. And so if you get audited, they will, pay for legal fees. If you lose, they're going to pay the tax, penalties, interest. But they will only insure if you can get a legal opinion that says more likely than not, which is more than 50%, that you've got the right position. Okay. So I think 1202 is another one of those that it could be an opportunity that especially if this is a once in a lifetime liquidity event and you just don't want the IRS knocking on your door, you can price it out of what, being 100% in the clear that this is going to be your money. Now, one additional point is the tax insurance itself can be taxable. And so sometimes you have to buy additional insurance, which pays the tax on the insurance. It is possible to pay premiums and know for sure you're good. You just give them money, and then if the IRS comes knocking, you say, I don't care. I already got my 0% tax rate.
Gotcha. Okay. Any concluding thoughts on any of these topics that you want to share?
Yeah. So, when people ask me, what does this bill mean? It really, and I'm not getting into the other stuff. I'm just pure tax here, right? Really much more status quo than you might think. You might see your rate go a little down because of increased standard deduction, et cetera. You might see your rate go a little up because charitable deductions got a little haircutted. But if anything, it's mostly status quo with some of these really great programs and benefits that we had full access to at 2018 that were starting to go away, we're back. It's like we're back in 2018 again. So the big thing I always tell people, if you've got capital gain, take a look at these opportunities. Take a look at opportunity zones. Take a look at investing in a business and getting bonus depreciation if you can be active in that business. And then, of course, choice of entity is huge. If a C Corp's the right call and you can get QSBS, awesome. If not, we didn't get into it. The pass-through deduction is made permanent, so that makes pass-through businesses more beneficial. So if you like not paying as many taxes, this bill is probably good for you because you're going to pay a little less in tax. But mostly status quo. We got our toys back. It's kind of exciting.
Absolutely. And from my perspective, I think it makes planning, we're kind of all holding our breath until this thing was signed into law. And now that a lot of the stuff is permanent, or like you said, we're back to 2018, it makes planning for the next couple of years with a lot more certainty, right? We're not saying, oh, well, wait a minute, TCJA is going to expire. We got to be careful. We got to wait to see. It's like, okay, we now know, regardless of whether you like it or you don't like it, and you've got some certainty around it, and you can do planning. And I think that makes, being a tax advisor like us, I think that makes our jobs a lot more straightforward as to what the options are. Give those data points to the client, let them decide.
Absolutely.
All right, fantastic. Well, thanks for coming on.
Yeah, thanks for having me.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.